Hey everyone, it's Daniel here from InfoVest. Hope you're all doing well. So I've got a question for you. All this QE prediction of rate cuts, is it really truly good for the markets? Is that a good sign? The fact that we've been doing QT, we've been seeing rate hikes, is all of a sudden a need, and a very massive need, and a very massive 180 twist from especially the bond market jumping and the yields basically dropping 50 basis points or more. Is that a good sign for the markets that, hey, such a big twist overnight where we were literally pricing in higher rates, 5.5% to maybe 5.7, some people even predicting 6% in interest rates, to then in one day we've got a repricing of going from rate hikes to now all of a sudden rate cuts, right? The market in the US is predicting, the bond market especially, predicting rate cuts for 2023. In Canada, for the Bank of Canada, the bond markets in Canada are predicting that at least we're going to see rate cuts in June, probably a 50 basis point rate cut by then. So that should be good, right? Good for markets, good for real estate, good for stocks, etc., etc. Or is it? Well, let's look back in history. In 2019, when the Fed decided to do QE, not QE, and cut rates, what happened? What followed after all of that? Was the 2020 COVID crash. Right? Now you could say, okay, that's a black swan event, no one would have predicted that this would have happened. So, okay, let's rule that out. But let's not forget about 2008. Bear Stearns went under, they got a bailout, they were bought out. What happened afterwards? You had the Fed coming out and easing, cutting rates, and the stock market, even though with the rate cuts, the stock market crashed. What about in 2000, when the markets, when the internet bubble really finally blew up? What did you get then? You had rate cuts, right? And while rate cuts were happening, you had the stock market and NASDAQ completely plunge about 80%. So what makes this time different? Could we see? Sure, anything's possible. This is all a probabilities game, and I'm no financial advisor, so don't take any of this as advice, right? Always consult with a financial advisor. But if I look at history and I look at how things played out in the past with the Federal Reserve and how the stock market reacted, even with some easing like we're seeing today, the QE, not QE, pumping of money, global central banks coordinating to inject more liquidity, $2 trillion in, 4 months of QT, of tightening that we've done have been reversed all in one day, right? All of that completely changing with the pumping of money. Is this the sign that things are about to get worse? Things are about to break? Right? One may think, okay, they're injecting liquidity, they're about to cut rates, and hey, that's a good sign. So go all in, right? But that may not necessarily be true. It could happen this year. This time may be different, as many people say many times in the past. But yet, whenever anyone says that quote, they tend to be wrong. But could it be that this time is different? We do get a soft landing, and the economy, doesn't really crack and break and completely break. I mean, it has cracked. We see the cracks with the regional banks, with the Fed, Credit Suisse, and so on. These are very alarming signs. So that's why you're getting the markets, and especially the bond markets, pricing in that, hey, rate cuts are going to come. They're eventually going to come because something is breaking, something in the system. Now, you and I, we're just, unless, you've got inside contact or inside information, but I'm guessing, speculating here, that you and I don't have the Federal Reserve on speed dial and don't have very good, stronger insights than maybe the central banks out there around the world, or the head honchos of the world, or the billionaires of the world, like they do, on what's happening with the banking sector. There might be something there that we don't know that is looking really, really scary. And that's why we are seeing that Credit Suisse getting bought out for a very, very big discount. A lot of these regional banks as well, right? This is all an effect, and we're seeing the contagion effect. And if the markets and the bond markets are saying, hey, this is going to get worse, and something is, the economy is going to really, really, we're going to see the real effects of hard landing, then that's when you get that pricing in of rate cuts to come sooner, like June, like the summer, or if not the summer, then for sure, by the end of this year. Now, couldn't the markets be wrong? Of course, 100%. The markets were predicting, right? Initially, they were saying, okay, we're going to get at least one rate hike in December. Sorry, one rate cut in December of this year. Then completely flipping to saying, okay, no rate cuts in December. We're just going to hike, and pause, and no rate cuts. So then all of a sudden, the regional bank issue, and now pricing in a lot of rate cuts this year. Massive rate cuts this year, because, hey, okay, now we're seeing something is breaking. And that the markets that are pricing that in, especially early in, is a signal that may tell you that, hey, this contagion effect could get worse, and we don't know what exactly it is. It could be, some people are saying the next domino to fall is the commercial real estate market. A lot of banks or other banks that are really exposed to the commercial real estate market might see, more losses that may exacerbate and may cause this domino effect to get worse. And even if this domino effect gets really worse, it may catch the stock market off guard, may cause a lot of fear, liquidity issues in the markets, hardly anyone buying, more sellers, which may cause that sell-off like we've seen in previous recessions, which might most likely bring the central banks to start easing, conducting rate cuts like the bond market's predicting. Not me, I'm not predicting this. The bond market's predicting the rate cuts, and then also QE. And then that would be probably the cushion for the markets that, hey, everything's going to be fine, because, as always, the Federal Reserve and the central banks come to the rescue. So it's going to be very interesting to see what comes out over this couple of months. You're going to have to be data dependent, watch how inflation is, and most importantly, watch the signs of not only these banks going in trouble like we're seeing already, and if you look at a lot of the big banks as well, the bank stocks, Wells Fargo is one of them, you're seeing still continuous selling pressure. Now that can all flip, because this Wednesday, we've got the central bank, U.S. Federal Reserve, coming out to talk about monetary policy. They're coming with projections. So it's going to be very interesting. What will they say? And could they say something that causes the bank stocks to completely rally and reverse higher? Or will we see that Powell will continue on pace, and then you'll see the panic selling in the markets like we've seen in previous recessions? So no doubt we are in a recession. No doubt we're seeing the cracks, the banking sector. I've done videos on Blackstone, BlackRock, withdrawals of halting withdrawals, investors' money. On top of that, Blackstone's private equity mortgage fund basically defaulting. These are all the cracks that are starting to snowball, and the snowball is starting to get bigger and bigger, and eventually that snowball is going to hit a very big wall that's just going to splatter all over. So it's going to be very interesting to see how the bond markets start to price in more rate cuts than what they're pricing right now, or complete, or do they reverse again saying, hey, this effect that we're seeing, this is the end of the contagion effect, it's not going to get worse, and we go back to pause or maybe rate hikes. I don't know. I'm more leaning towards that, hey, we might see more rate cuts come in, or bond markets price in more rate cuts, because it's not looking good and you're seeing the cracks and you're seeing the issues, especially when you have global central banks on a weekend release that they need to pump more money, more liquidity in the system. So let me know what you guys think. Leave a comment below, subscribe, hit the like button and the bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.